Okay, so good morning and welcome to another webinar with FP Markets on behavior biases, which I feel is a fascinating topic. Good morning, Daniel. I see you said hello there. So I will say from the outset that this is a dense presentation and I will be throwing a lot at you. So please do rewatch the recording if you feel the need to. For those new to the webinar series, my name's Aaron Hill and I'm one of the market analysts here in the research department at FP Markets. So look, regardless of how sophisticated our technology, humans are the driver behind market movement. Computers, or should I say, powerful computers, execute demands, though are void of emotions, and quite simply they follow orders. Technology does not care about profits or wealth creation, though humans, the majority of humans that is, do care. So what I intend to do is to try and show during this 1 hour segment is what is with all this human drive, shall we say, comes with it human imperfections and errors. I am certainly not saying you have to agree with the biases I talk about. I am simply highlighting research from the field of psychology. So what I'm saying here is please use this to form your own opinion. Some of these biases will immediately jump out and say, yep, that's me, while others may be a little on the, you may feel that you're a little uncertain with these biases, I guess you may say. Before I kick things off, over to the next slide. I trust we can all see the welcome slide, and the audio is tip top. If not, please let me know in the chat box. Okay, Jane, you say you have no audio. Guys, could you just do me a very quick favor and just type Y or N in the chat box to see if your audio is up and running? Yeah, okay. Jane, that may be on your side there. I'm not sure. Maybe check your audio connections because everyone else is saying they can hear me. Apologies for that. Thank you, guys. Thank you. So look, questions missed during this presentation, please do email me and the research team at marketanalyst@fpmarkets.com. This is also where you're free to send across, comments about the presentation. Or any topics you feel that we could cover in future webinars. Now, as usual, I'm just going to quickly run through the disclaimer on the screen. The information contained in this material is intended for general advice only. It does not take into account your investment objectives, financial situation, or particular needs. Look, guys, all this is really saying is this is not investment advice. This is for educational purposes only. So moving swiftly on, behavioral finance. So behavioral finance has helped the way we interpret investments and decision-making structure. It is essentially a field of study focused on how psychological influences, i.e., in other words, the biases, can affect decision-making and ultimately market outcomes. Although researchers in the field of psychology have coined several classifications for biases, cognitive and emotional biases form the umbrella for many common, shall we say, behavioral tendencies. So traders and investors are likely to be less susceptible to the effect of these biases if they remain vigilant to the possibility of their occurrence. So with that in mind, we must know, it's worth noting that the general dictionary definition of a bias is, as you can see, a preference or inclination to favor a viewpoint or an outcome. So just keep that in mind as we spin over to the next slides. So although research has seen, as I said, several classifications, cognitive and emotional biases, as I already said, form an umbrella for many common behavioral tendencies. So cognitive biases arise from from information processing errors or memory errors, essentially highlighting faulty logic, or I guess you could say blind spots. Emotional biases tend to stem from, say, impulse and intuition, diverging. So think about it like this. So diverging from rational decision making. So according to traditional finance, is a direct result of of emotional biases. Reasoning influenced by feelings or emotions. So biases derived from faulty information processing are often easier to identify and ultimately correct than emotional biases. Further education and better information and advice can often help. Whoops, sorry guys, can often help correct cognitive biases. But as I said, with emotional biases, these can be harder to identify and ultimately more difficult to adapt to in order to minimize their influence. At the end of the day, though, education can alleviate both kinds of biases. The more you know about these biases, the better analyst, the better portfolio manager, the better trader you will be. It's also important to note that specific biases, so cognitive and emotional biases, will share cognitive and can share cognitive and emotional components. So cognitive biases are classified into two groups, as you can see here. We and below that we have a number of subgroups, which I will briefly touch on in a minute. So belief perseverance bias. So this is a bias or a tendency that, this is a bias describing a tendency to, irrationally maintain established beliefs despite new information or evidence. This is essentially saying that no matter what evidence is thrown our way, some of us have a tendency to cling on to and justify a belief because of, their bias toward belief in themselves or their own ideals or abilities. I know this is likely to confuse some here, but once we kick over to the individual biases, it'll be crystal clear, I think. So then we have information processing biases. So again, this forms under the umbrella of cognitive biases. We have two. So information processing biases, as its name implies, involves how you process information in financial decision making. So as opposed to clinging to one's belief in the belief perseverance bias, information processing biases have more to do with how information you're given is processed. Again, hopefully this will be clearer very soon. So the first bias under information processing biases is called conservatism bias. We have a question. Can some biases grow when you get a row of winners? Now, Daniel, I'll let you be the judge of that. Once I go through a couple of these biases, I'll let you be the judge of that, okay? If not, I'll come to that question at the end. So conservatism bias involves maintaining prior views or even forecasts and dismissing new information. What this means is you may overweight your initial beliefs, disregarding fresh information. So an example of this is say you are long the pound dollar on the expectation of an imminent interest rate hike. The technical landscape has provided numerous straightforward entries which you have added to your initial position, and you're quite pleased with your actions. The issue is the Bank of England, despite many desks, pricing in a rate hike, the central bank leaves the bank rate unchanged at its next policy meeting and signals an indecisive tone about upcoming movement. This, of course, sends sterling lower. As a result, you may hold the currency. You may hold the currency longer than justified, failing to act on the new information from the bank, essentially making you too slow to react. So what this tells you is those who suffer from conservatism bias is to remain as objective as possible in trading and to include new information as and when it is identified. This could mean the trader in our hypothetical situation of the pound dollar, the long position on the pound dollar, lightens their position on the new information from the central bank, or liquidates the entire position to wait for more information before re-engaging with that particular currency pair. So another point I want to highlight regarding this bias is that it can guide some to maintain a prior belief rather than deal with the mental stress of processing new information to update the position. What I mean by this is if new information comes along, that could mean you have to reevaluate your entire outlook, which can be a lot of work, of course. So sometimes conservatism bias is out of simply laziness rather than unwilling to accept the new information and material. So that's conservatism bias. We have a lot more to get through. Next up is confirmation bias. Now, this is an interesting one, which I'm sure most of us can relate to. Confirmation bias is sometimes referred to as you can see on the slide, selective perception. After making an initial trading or investment decision, you may notice information in a manner that supports your viewpoint. The problem is when you only observe confirmatory information and overlook or modify contradictory evidence. This, of course, can be an issue. So basically, you'll notice things that validate your view and undervalue aspects that counter your opinion. So as an example, say you're long, this could be any security, say you're long Tesla. And then anytime you see a positive article on Tesla, that confirms your outlook and you're like, yep, I knew I was right, and continue on buying and continue on buying into that market. But at the same time, you're ultimately dismissing on the stock price in the future, or even justify an exit from your current position. So really what confirmation bias highlights is an investor accepting research that confirms current trades or positions rather than looking for information to justify an exit. Look, I'm sure most of us here will agree that looking for information to justify an exit is hard to do because we all want our positions to continue rallying or advancing. I understand that. But to become a consistently profitable trader, we have to remain objective. We have to look for things that inform you that the position is weakening. So that's the main point I want to get across with this kind of bias is confirmation biases. It's selective perception. Remember that word. And to become a consistently successful trader, as I said, we always have to remain objective. So next up on the stage is representative bias. So basically what this is when people classify new information based on past experiences. If we think about it like this, so when patterns look the same, we tend to draw conclusions based on this. So an example is the crypto market, cryptocurrencies is overheated, just like the dot-com bubble. This is not my opinion, by the way. I'm just trying to give you an example. So we could say cryptocurrency market is overheated, just like the dot-com bubble was. So the crypto market is going to crash, just like the dot-com bubble, dot-com market did. So people are basically taking positions based on what they remember happening in the past. So it's like taking new information and putting it in a box and based on previous experiences. An example is we may see, very similar to what I just said about the dot-com bubble, as we may see that current market conditions resemble a growth period back in history, and could have the trader base trades on this similarity and fail to do in-depth research. So another example is new information can be classified too simply, right? Rather than properly examining its structure. We simply throw it in a box that represents this past example, which I am sure you can appreciate is an incredibly risky, a very risky approach, and not a bias I would recommend. Okay, next up is illusion of control bias. This is an interesting bias in which the trader or investor feels they have more control over the outcome of an event than they actually do. Most, however, will recognize there is limited control. Now, I'm sure some of us here have fallen under this bias, maybe and didn't even know they were under this bias. So this can often be confused with overconfidence, a bias which many relates to emotions where a trader or investor is so set in their ways, so they're refusing to change due to overconfidence. But many will agree that illusion of control can obviously lead to overconfidence. So look, a good example of this is a trader who believes they have control over the outcome of a stock moving to a stock or a currency pair moving to a specific level. By thinking one knows the outcome through, excessive overconfidence, excessive risk taking may take place, because if you believe you know the outcome of the event, why not risk more to gain more? That just makes sense to me, right? If you believe you know the outcome of the event, traders will often risk more. So another example is where an employee a part of a company, and this can lead investors to hold large positions in that company's stock. So it is clear because they believe they have some control over the outcome of that event because they are part of that company. So it's clear that most investors, whether you work for a company or not, have little to no control over the price valuation of a stock. This should be plain as day obvious. So next up, hindsight bias. This is when we believe past events were predictable to expect or reasonable to expect. So I'm sure most of us here have fell victim to this bias. So a good example of this is the 2008, the 08 real estate bubble. Now, many say, of course, this was obvious. Many say now that that it was obvious the market was going to tank. Treasuries were higher, for example. People tend to remember their own predictions of the future as more accurate than people tend to remember their own predictions of the future as more accurate than they actually are. Because people do not have perfect memory, when they look back, they reconstruct the gaps they prefer to believe. The story sounds much better if I said, yep, I predicted the 08 crash. Simple as that. An example of this is to overestimate the degree to which you predicted an outcome, and therefore it gives them a false sense of overconfidence. Usually, again, it leads to excessive risk taking, which means taking on larger positions than you actually should. Okay, so the next up is one I particularly like, is the cognitive dissonance bias. This cognitive dissonance occurs when newly acquired information conflicts with pre-existing beliefs or pre-existing understandings, which causes discomfort. So think of it as a state of imbalance. When new evidence or beliefs are introduced, people will go to great lengths to defend their belief. struggling. So that what they do is they struggle to harmonize with new cognitions. Cognitions are essentially beliefs. So a market-based example of cognitive dissonance could be something like when investors hold a security or hold positions longer than necessary, because they want to avoid the mental pain associated with admitting that they made a bad decision. Now, I'm sure many of us here have fell victim to this. I know I have. Another one, of course, can be when investors continue to buy more after the price has failed. So they struggle to process how they may have been, wrong, and probably feel that with that drop, it's now better value rather than, So look, rationalizing to ease cognitive dissonance prevents us, as you can see from the slide, from learning to avoid similar mistakes. Okay, so that was the belief perseverance biases. I know I'm throwing a lot at you, but as I said, please do consider watching the recording to go over this, and any detailed replies you need, just send me an email. I'll give you the email. Oh, the email's already in the chat box, so please do go ahead and email me, and I'll get back to you with more detailed explanations if needed. So, information processing biases. Given the time constraint, I have handpicked a few information processing biases to cover. Remember that the information processing biases are the process behind how we process information in financial decision making. So just quickly, we're going to be looking at anchoring and adjustment, mental accounting, framing, availability, self-attribution, outcome, and recency bias. And then we'll go on to touch on to some emotional biases that many of us will have likely encountered. So first up, we have the anchoring and adjustment bias. When presented with new information and asked to make an estimation, people will usually go to great length. People will usually start with an initial default number. This is their anchor. So a common question is, where do I think this stock is heading to? And there's often a number people think of, and following this, they make adjustments to that number based on to reflect subsequent information, so price movement or analysis based on rules of thumb. Regardless of how the initial anchor was chosen, people tend to adjust their anchors insufficiently, as estimating something based on rule of thumb, as I'm sure you can agree, implies that this is not thorough research. It's simply an estimation. So a basic example of this is traders place too much emphasis on, say, on price levels like the 20,000 level, 20,000 mark, or on an index. So say the Dow. I know it's not, but I'm just trying to give you an example. So the 20,000 as a resistance on the Dow. This can also cause analysts to wait too long before they downgrade a security that they were bullish on before. Okay, next up, mental accounting bias. And this is an information processing bias in which people treat one sum of money differently from another equal sized amount. So people value the same amounts of money differently depending on which mental account the money is assigned to. So the value of money, or which mental account it fits into, ultimately depends on the source of the money or what the funds were planned for. So if the funds was from your salary, this may be viewed differently to, say, a lottery win or an investment capital gain. I know this happens. I know this bias is very, very common because I do this. And I guess you can say it is a little crazy because money, of course, is fungible, which is that it's replaceable by another identical item, so be it a coin or a note. So we essentially identify money in baskets. So one obvious example of this from a market-based perspective is stock traders, stock investors, should I say, who seek yield income at the expense of capital appreciation. So the capital loss is essentially overlooked if the income stream is provided. So really, you would need to earn a lot of yield here in order to make up for the loss of capital appreciation. But those suffering from the mental accounting bias, falling victim to the mental accounting bias, will not really compute this. They're just looking for yield, and they're not really too fussed about the capital appreciation. Framing bias. This is the way. This is when questions are basically answered differently depending on the way that they're asked or framed. So an example of this could be the following question. I've got 20% on there just to remind me of this example. So look, this is a question. 20% of sick people. So you could even test yourself here. I'm going to ask you this question. 20% of sick people who receive X will survive. So let me repeat that. 20% of sick people who receive X will survive versus 80% of sick people who receive X will die. Whether you say yes or no to this depends on the way the question is framed, even though the question is exactly the same. So I hope you're seeing the connection here. So the first representation would see people tend to respond and adopt a more positive outlook based on a gain frame of reference. So remember, 20% of sick people who receive X will survive. This is the gain frame versus will die, which will have an impact. So the second representation may trigger a negative outlook based on the loss frame of reference, i.e. will die. So as an example, this could mean, so as a market-based example, this could mean, depending on how a question is framed, we could select unsuitable investments based on the information presented and the way it's framed. Okay, I hope you understand this. I hope this is coming across clear. Okay, the next one, availability. The next one, availability bias, is where you take a rule of thumb and a rule of thumb approach to estimating the probability of an outcome based on how easily the outcome comes to mind through memory. Daniel, I'm not sure of your comment. The answer is suppository. I'm not sure what you mean by that. Can you maybe explain a little bit in more detail? And I assume you were talking about, okay. All right, so look, back onto availability bias. A quick off the cuff example of availability bias is people are afraid of flying more than driving because, you know, think about this. There are far more detailed news stories following an event of this nature. So a plane crash, for example. This is despite the probability of a car crash being much higher. So it's because of the availability of this information when there are good trades to be had. So think back to 2009 when the market started to recover. Many still had the pain of loss in their minds from the 08 crash, right? From news and things. So most thought it was not a great time to be buying, obviously, shares. So what this can do to an investor is it may limit their investment opportunities to securities that fall that fall into familiar categories based on the availability, or based on the availability of that event. So another example is choosing an investment advisor based on, you know, cool advertising or major advertising that's available. So yep, the next one is the self-attribution bias. This is where people tend to ascribe their successes to innate aspects such as talent, and they often blame failures on outside influences. So an example of the top of my head is a student at school who does well will often take credit for their and rightly so, for their work. But when they fail, they can often blame grading systems. Most people, I hope, will grow out of this, but some do not, of course. So with this in the financial world, what we can see happen is traders and investors feel their successes was all them, and therefore can lead them to take on more risk and essentially overtrade. So what they're doing here is they're only listening to what supports or confirms their belief again. So this is the confirmation bias we looked at under the belief perseverance bias. So basically, I think of it like this as people who trade that think they're so smart and cannot essentially go wrong, and hence take on larger position sizes, and they eventually crumble. This is not a place you want to be, of course. Okay, next up we have outcome bias, and this is where traders and investors they place too much emphasis on the outcome of previous events. So this is a very dangerous one to those who fall victim, I feel. If we were to place too much emphasis on the returns over the past, say, 5 years, rather than by looking into the process of by which the outcome came about, what strategy the investment method used to achieve those results. So a common example of this is where you may see this as, I'm just trying to think of the best way I can explain this. It's where you may see, is this it? Trying to think. So look, trying to think of the best way I can put this across, because this is a very important one. So look, what investors do with outcome bias is they base their decision on previous yearly returns, right? Rather than researching the probability of subsequent positive returns occurring. And a strategy with high risk is likely to blow up eventually. So if you're investing, so look, this is similar to the phrase, past performance is not a guarantee of future performance. Of course it's not, but that does not stop us all looking at the past performance to help base decisions. I hope that's come across relatively clear. If there's any questions on this, please do fire them across, and I'll come back to this slide. Okay, next up is recency bias. As its name implies, shows people emphasize recent events than those that occurred in the past. Think about it like this. As time goes by, the perceived risks associated with past events decreases. This should be clear for all of us here, that as traders and investors, we need to analyze the markets from an objective point of view and not only be swayed by the recent events. So what this can see from those affected by recency bias is they base a strategy only on recent events. Of course, the backtest would be far too small to really give us a concrete sample of backtest history. So another clear example of this is is a retracement within a major primary trend. Now, for those who follow the Dow theory will know primary trend is the major trend, which can be found on a weekly time frame largely. It's the major trend. So a retracement within a major primary uptrend. So during the retracement, focusing traders that suffer from recency bias will only focus their attention on that retracement, and we begin to think this is a terrible environment, and this is not a buyer's market. But taking into account the overall market picture, by not succumbing to recency bias, you will see, in fact, that this is the perfect time to be looking to buy, because you're in a retracement within a primary uptrend. Okay, that's the information processing biases. Okay, so we have a question here. Training people, is there one you have seen more over the other, or you have a personal ranking on the occurrence? Daniel, I'm not sure what that question means. I'm sorry. Maybe if you can try and explain that a little bit more clearly, so I can maybe reply to it. Sorry about that. So look, so next up is the emotional biases. Let me just okay, so remember, as I said at the beginning, these biases can be a little more difficult. So emotional biases can be a little more difficult to pin down, and also are thought to be more difficult to correct. However, they're still crucial to be aware of, so that we can try and work around them and as best we can, and adapt as best we can. It is said that emotional biases will seldom disappear. So if you suffer with it, it's likely you will always suffer from it. I emphasize the word likely because you can never be sure, and because the majority of us will always likely suffer from an emotional bias, it's important to identify the biases and hopefully learn to adapt to its effect. So the first one is loss-aversion bias. This is essentially when one prefers to avoid losses than achieve gains. This may sound absolutely insane, I know. Let me just repeat that. So when one prefers to avoid losses than achieve gains. But this is very, very common. The theory is based on research that from a psychological standpoint, losses have a significantly more powerful effect than the gains, and can really, really cloud one's objective judgment. So look, a common example of loss aversion bias is something like when an investor accepts risk to claw back losses rather than to maximize gains. So imagine we are in the process of a losing streak, which I'm sure we've all been in. It's never a nice place to be in, but we are in the process of a losing streak, and we make dumb and risky trading decisions, trying to claw back those losses, rather than looking at the market from an objective standpoint. So another example is holding losses far too long in order not to realize the loss. So remember, those affected by this bias tend to want to avoid the loss. And another example, of course, as the bias states, an investor prefers to avoid loss than achieve gain. This could see us take profits too early, as they're afraid the trade will turn unfavorable and move into negative territory. So this is a very, very important bias we all need to be aware of as professional traders. But it's something we can often just believe that it's not there, but it truly is. I've suffered from this. I'm sure most of us here have as well. So do keep a note of this, of the loss aversion bias. Now, overconfidence bias is another emotionally based bias, and is one we should all be aware of, I feel. While I personally believe it is important to be confident when in anything you do, especially when trading, overconfidence is a dangerous cocktail. Those those placing unwarranted faith in their abilities and their reasoning. This could see those suffering with this bias that they will overestimate their knowledge levels, for example. People are usually poor at estimating probabilities, though they believe they do it well because they are smarter or more informed than they actually are. But sometimes, just sometimes, we are just lucky. So overconfidence bias can lead us to underestimate risk and also overestimate gains. It can also trigger a bout of overtrading, which I'm sure most of us have succumbed to in their time in trading. And also, it can also see some sidestep the use of stop losses because being wrong about the trade seems unthinkable when you're suffering, when you're falling victim to the overconfidence bias. Self-control bias. Now, this is a bias which some of us fail to act in line with their long-term objectives through a lack of self-discipline. So with this, what it's really saying is there's often a conflict between short-term satisfaction and the achievement of one's long-term goals. Think about it like this. So it is far better to go through the pain now and have gain later, rather than having short-term gain now and then feeling the pain of, say, regret later on. Look, so short-term satisfaction can interrupt long-term goals. This should be obvious. This can be seen with, savings, for example, our savings account. How many of us here struggle to save money and display a lack of control with their money? Some of us here will, of course, fit into this bucket where they lack control, as some will prefer smaller payoffs now rather than working towards a larger payoff later in the future. So I guess you could say retirement is a clear example. Retirement savings. So in the markets, those who suffer from self-control bias may hold their positions too long, and also risk more in hope of gaining more in the near term, rather than slowly building their account with many consecutive small profits. So another example of this, of course, is too much importance is placed on dividends rather than steady capital growth. I know many dividend investors will, of course, disagree with this type of bias. Status quo bias, which is basically when someone does absolutely nothing, even though it might be time for a change. These are people that are more emotionally comfortable keeping things the same as opposed to changing, and therefore do not really look for opportunities where change may be beneficial. This may see some of us maintain a risk profile that is inappropriate, as we are comfortable with how we operate. This, as I'm sure you can see, this is a little unwise. If risk is now, for example, is now larger because of a drop in your account equity, sometimes we need to change. No, we have to change to adapt, especially where risk is concerned. So another clear example of this is if we fail to explore opportunities and therefore potentially leave additional returns on the table. Okay, regret-aversion. Okay, we have two more left, guys. Regret-aversion bias is the next emotional bias, which is a little like loss aversion, in that people tend to avoid making decisions that will result in action out of fear that the decision will turn out poorly. So what this means is we try to avoid the pain of regret associated with bad decisions. This can keep people in a situation because they fear they may walk away just before it gets better. So an example of this is we hold positions too long because we're worried that the position will make new highs, and we will miss out. So I'm sure many of us know here the fear of missing out, FOMO. It's essentially this. So look, essentially we want to avoid regret as much as possible with the regret-aversion bias. Finally, affinity bias. Basically, this is a type of bias that's showing us that some people have a tendency to make irrational, uneconomical consumer choices or investment decisions based on how they believe a certain product or service reflects their values. So a common example of this bias is when one purchases, so say for instance, wine. I'm sure there's many wine drinkers here. We might purchase an expensive bottle of wine in a restaurant to impress dinner guests, but an equally less expensive wine and just as tasty might be available. But that would not convey the same status as an expensive bottle of wine to obviously impress your dinner guests. So another example is someone might buy Tesla. Thank you. Someone just commented Tesla. Another example might be someone might buy a Tesla because it's an electric car to help the environment, which is important to them. So they have an affinity to electric cars and saving the environment. As an investment example, we might invest in certain companies that we have, as I said, that we have an affinity with, because they reflect our values or self-image. However, this can obviously lead to, I'm sure you can see this can lead to suboptimal investment. So if the CEO of a company you're looking to invest in has the same beliefs as we do, we'll invest in that company. But the reason we invest or trade, the reason I invest or trade is to secure a future. I would think that most of us here, by investing in only companies we have an affinity to, would make zero. It makes 0 sense as far as I see. Okay, guys. So we are now on the Q&A section. We have a comment here: hard to cut your losses and ride your winners. Yes, that's a comment from the kid. A very, very, very good comment there. It's very hard to cut your losses, and that goes back to one of the biases. I cannot remember which one. The loss-aversion bias, I believe. And yes, it's very difficult, and it doesn't make sense when you think about it, because it should be easier to make. It should be easier to hold on to your gains, because that will benefit you, and losses won't benefit you, so you have to cut them as quickly as you can. You spoke about many biases. Which one have you seen in most people? So I'm a big fan of understanding the emotional side of trading. So the emotional biases were a big thing for me. As I said though, these biases can. These biases, sometimes they're very difficult to identify, and in my experience, you can never really correct them. It's mainly always you learn to adapt with them, you learn to control them. It's like the psychological element of trading, which is often so overlooked by many traders, and they wonder why they struggle. What's the most common I've seen in most people? Well, the overconfidence bias is a big one. The self-control bias is another one, and the affinity bias, believe it or not, is another one as well. But all of these are very important in my opinion. So that's why I recommended that we do go over the recording if you're interested in this type of thing. But there is a lot of information on websites. Yes, that's an excellent comment from the kid. Mindfulness is so important in trading to identify emotional bias. So important, it is. The psychological component of trading is so overlooked. Unfortunately, it's just, and it doesn't seem to be getting any better. I place huge emphasis on the emotional side of trading. I never used to. When I first began trading, I was always focused on where to get in, where to get out, and that would be all I need. But it's not, because we're all emotionally different. We're all psychologically wired different. So, for instance, I may be fine with a 2% loss. I may be comfortable with a 2% loss. You may not be. And if you're trading with risk that's too large for your comfort level, this can often see you lead to changing your stop loss or and things like that. So it's really it's a crucial element. You're the first one who I really see speaking about this. Yeah, it's these biases are just they're really eye-opening. There's also investor psychology. I was going to add, believe it or not, I was going to add more to this presentation about investor psychology. So I would show you in the markets where you can see these biases coming into play, but I didn't have time, obviously, because I wanted to get this across to. But this is something we could potentially do in future webinars. I can go over more investor psychology, and we can look into that. But these biases are incredibly important. So another comment. So my worst one is trying to defend new highs gained in my account, trying to not lose gains. And oops, I've lost the comment. Apologies. Let me just try and expand that screen. Just give me a minute. Wow, that is a long comment. I'm not able to read all of that. Oh, what's gone wrong here? No, it's not you, Daniel. It's another comment. Just give me a second. I'm just trying to. Yeah, so the comment was, my worst thing is trying to defend new highs gained in my account, trying not to lose gains, and I analyze it and expect something to happen to a level, and then it does not happen, and then not giving up on the idea. See, this is where you need to understand the successful traders that I've met are so emotionally. The word, for lack of a better word, they're emotionally wired. They're so wired into this. There is no what's the word I'm looking for? Indecision. There is no hesitation. It is either this or this. If our stop loss is hit, we are out. If price moves unfavorably, fine, hit the stop loss, we are out. That is it. There is no if you're trading with an account that has been backtested, that you've spent the time backtesting, you will have more confidence going into your trading. But again, future past performance that cannot obviously predict the future. That was a bias that we looked at recently. I cannot remember which one it is though now. Because I've gone through so many. But yeah, so there's another comment here. Look, the kid, that's a really long comment. I'm not really able to read all of that. Okay, we've got another one. Aaron, can you put context or give your opinion on bias when using technical versus fundamental information? Can you put context or give your opinion on bias when using? So really, I've approached these biases from a technical perspective. I've not really thought about the fundamental side of things, but this is all from a technical point of view, and this is where you could see you can see a lot of this playing out on charts. Obviously not mental accounting or anything like that, but you can, especially the emotional biases, you can see these playing out on the chart. So I've approached this from a technical perspective. I can't really differ between the two. Yeah, Andrew, I hope you're okay with me reading out your comment. So a professional advised him that it's how the subconscious works, and I think it's helped, and I'm learning a lot. Yeah, Andrew, it's incredible the amount of psychological pressure that's placed on us when we're trading is just I cannot emphasize it enough how important it is. It really is. And I've really only just touched the surface with these biases. There are so many more. And as I said again, just please go over these. You don't have to agree with all these biases, but please do send me an email if you want to further chat about them or anything like that. Can you do a part? So comment from Daniel. I need to shoot off. I need to shoot off. Can you do a part 2? Would have to review the video when online. Yeah, no problem, Daniel. I just read your comment there, Andrew. Yeah, she was just helping with my trading. Wow, that's brilliant. Okay, so yeah, yeah, the psychological element. I've been a big fan of that for years now, and yeah, so I can wholeheartedly recommend, especially for newer traders. This is something that you should always look into. One of the first things you should look into, in fact, is look into the biases that we adopt and the psychological components all around trading. Elliott wave theory is great as it optimizes on the bias from the herd mentality. Yeah, I kind of agree with that, the kid. I don't trade Elliott wave, but I have a brief understanding of that. But yeah, this is where most of these patterns actually are developed from, like the biases that we see, as far as I understand. Okay, so all right. That's all I've got time for today. Look, as you can see on the screen, there should be another email on there, really. So any comments or feedback you have for this session, please do send them either to support@fpmarkets.com or even the market analyst at fpmarkets.com. Look, it's in the chat box, guys. If you have any comments or you want to chat about anything else that we've shown here today, please do send me an email and I'll get back to you as soon as I possibly can, or one of the research team will. Yeah, so thanks again. Look, I hope you were able to take something from this. Again, please do look at the recording. The recordings are available on YouTube under FP Markets, or alternatively, go to our main website under the resources tab, and all the archived webinars will be available. Yeah, so look, thanks once again. Thank you for taking the time to join. Have a great day, and I'll see you all again very, very soon. Thank you very much.